Hello, good morning everyone. Welcome to lecture number 10, Relevant Cost. And as you know, this is the last formal lecture. There is another lecture next week, but that would be a review lecture focusing on the chapters that we already covered. So today's lecture is the final lecture of this module for this semester. So today's lecture is on relevant cost for decision making. Introductory issues that we will cover this lecture. So decision making, what is decision making? So decision making obviously is something that we make, that we decide, that we set for future. Whether we should do or shouldn't do anything in future, that is a decision. How we make the decision. So we can see here 5 steps of the decision-making process. So firstly, we have to identify the issues, the issue or the act or the phenomena on which we are making a decision. We have to identify the problem. Okay. So for example, whether we should buy raw materials or we should make or process raw material by ourselves is a decision. Whether we should sell a product or we should stop selling a product. Whether we should produce a product or stop or discontinue production, or we should so we have to identify the problem that on which we are making decision. So if we want to make decision, we need relevant information. The second step is collecting relevant information, and obviously relevant and accurate, reliable information we should collect to make the decision. So after collecting information, what we have to do, we should evaluate the possible courses of action. What are the options we have? We have to identify the options and evaluate the option. So if you have, say, 3 options, we want to buy some raw materials, and how many suppliers we have? So we have 3 suppliers. So we can buy from Japan, we can buy from China, we can buy from Germany. So we have 3 options. And what are the advantages and disadvantages of these options? We have to identify. We have to evaluate. And after evaluation, we have to make a decision. Make the decision from which supplier we want to buy, and then we have to implement the decision. That's the 4th step. And finally, after implementation, we can evaluate our performance, or evaluate the performance of the action, evaluate the decision that we made before. And what's the impact of that decision on the performance of the organization, and what we learn from that. So, and then if we see that the decision that we made is not good for the organization, then we can change the decision in future. That means what we learn from the decision. What's the impact and what we learned and what we should do in future. We can think, or we can use this information in future. So usually in case of normal business activity, what are the decisions usually we make? Some decision areas can be investment decision, whether we should invest or not, whether we should replace an equipment or we should buy a new one, or we should repair it. selling price decisions. What should be the selling price? Whether should we sell at this price? And what will happen if we sell at this price? Product mix decision when capacity constraint exists. So if we have some constraints, raw material constraints, labor constraints, or constraints of the machine hours, then which one we should give preference, which product we should produce first. So these are decisions. Outsourcing, should we make or buy? Should we make the parts for producing the product, or we should outsource it? We should get it produced by someone else. Or finally, or maybe whether should we continue or discontinue a particular branch of an organization, a particular product, a particular division. Should we continue? For example, one branch is losing. So whether we should continue that branch or discontinue or close that branch, then that product is an important decision. So these are kind of common decision, management decisions, where management accountants provide supporting information to the management for making decision. So in case of making decision, what we have to do, we should consider only relevant costs and revenues. So there may be relevant information, there may be some irrelevant information. So if we consider irrelevant decision in case of irrelevant information in case of making decision, then our decision would not be accurate. So we have to collect and consider relevant costs and revenues for making decision. So what is relevant cost? What is relevant revenue? So the relevant cost of revenues is the cost of revenue that changes between alternatives. Okay, so if we buy a material or if we make a material, what will happen to a particular cost? So we have two options. One is make, the other one is buy. So if a particular cost, for example, factory rent, production manager's salary, what will happen to that? Will it change if we buy? Will it change if we make? Then if it changes between the alternatives, if we buy, we don't need factory operations. We can buy and then sell, no factory operations. But if we make the product, we need those production manager's salary, factory rent, or other variable expenses, we need those. So that changes, the cost changes between the alternatives. So in that case, the cost is relevant. But if the cost doesn't change, then it is irrelevant cost. So if we say the fixed rent of the factory, fixed salary of the production manager, if we produce, we have to pay the salary. If we don't produce, if the production manager is a permanent staff, we have to pay the salary. So whether we make or not, the salary will continue. So that means it is irrelevant in case of making a decision whether we should make or buy a particular product. So what are the basic criteria of determining whether it is relevant or not? Are occur in future. The cost, what we are thinking, should be in future, should be relating to the future operations. And the second criteria, differ between alternatives. It should differ between alternatives. But when it can be irrelevant, for example, historical costs, right, are irrelevant. Historical cost means the cost we already spent. we purchased a machinery. So the cost already incurred by the organization. So they are called sunk cost. The cost what already done, already incurred, already spent are sunk cost, already done, already spent. So the cost which already spent are irrelevant cost, has no impact on decision, and we should not consider this cost in case of making a decision for future. Some examples will make our understanding clear. So what costs are relevant and which costs are irrelevant, non-relevant. So future cash flows, the expenditure should have some sorts of impact on future cash flows. Cash expense that will be incurred in future as a result of a decision is relevant cost. So if we make a decision which has some sorts of impact on future cash flows is relevant. But if it is sunk cost, the cost which already spent before, these are non-relevant, irrelevant, that we already discussed. Because this cost has no impact in future cash flow. Avoidable cost, the cost which can be avoided in future because of taking decision, by making any decision, if we can avoid some cost. Those costs are avoidable cost, and avoidable costs are relevant cost. So if we make a decision relating to make or buy a product, so if we make a product, we need raw material. But if we buy the product from supplier, we don't need raw material. So the raw material cost can be avoided by purchasing the material from supplier. So if you purchase, you can avoid raw material cost. So the raw material cost, labor cost would be avoidable cost, and avoidable cost would be relevant cost in case of making decision for making or buy a product. Committed cost means the cost which we are committed for. We have given a commitment. So for example, we purchase the machinery, then when we purchase the machinery, we have a commitment that we have to incur depreciation, and depreciation will continue. If we use or don't use, the depreciation of the machinery or the furniture or the equipment will continue. This is a commitment cost. Another example can be easy for you to understand is commitments. For example, we employed an employee, production manager, or production employees, permanent staff, permanent employee of the organization. If we employed someone permanently or for a particular period, say 5 years, so I have given him a commitment in his appointment letter that I'll pay you a certain amount of money every month. That's a commitment. So whether he works, whether the production is continuing or his work is reduced, he's working more or less, right? Whether the organization uses him a bit less or a bit more will not impact his payment. He'll get the payment. For example, because of COVID-19, organization is stopped. For 2 months, there is no production. There is no activity. Okay, so it doesn't mean that the employee will not get the salary. If he's a permanent staff, full-time staff, he will get the salary, though he is not working, or he's working from home, but maybe his work is reduced. He's done the work what he is supposed to do. So that is committed cost, and committed cost will continue irrespective of the decision that we make, and that's why it is irrelevant. Opportunity cost means what? The cost that is incurred because of choosing alternative decision, the benefit lost from alternative decision, or because of choosing alternative option. So for example, you have two options to choose from. So you have some money, you can invest in a business, or you can deposit the money in your bank account. So you have two options. You can choose one, or you have to choose one. So if you choose that you will do business, so you are losing the opportunity or the benefit or the interest from bank. So the opportunity that you are losing is your opportunity cost that you need to consider in case of making decision. It is relevant. In case of making a decision whether you should deposit money in your bank account or you should invest in a business is relevant cost. Non-cash expenses usually are irrelevant, such as depreciation cost. Is not impacted impact your future cash flows. Incremental cost, because of making any decision, because of the decision, if your cost increase or decrease, are relevant cost. If you can save some cost, if you can reduce your cost, or if the cost is increases. So these are relevant cost. Incremental cost means the cost which increases because of making a decision. So how much you are spending now, and what will happen if you make a decision? If cost increases, or it can decrease as well. So decrease means avoidable, incremental means increase. So these are relevant cost. And general overhead, that is usually spent in the head office, that is allocated to different branch, and which usually don't change because of making a decision. These are irrelevant. So we should understand clearly which one is relevant and which one is irrelevant, and then we can use those information for making decision. Hope you understood. Hope which cost would be relevant and which cost would be irrelevant, which revenue is relevant, which revenue is irrelevant is clear. So we would be able to solve some questions. So mostly our lecture would be our mathematical lecture today. So we will solve 4 questions in the next part of the video. Thank you very much for watching. See you in the next video. Thank you.